Continuing our discussion here of bonds, we're going to talk here about the term structure of bond, which basically is just thinking about the length of a bond and how that's relevant in determining interest rates. So basically, if we think about what we have seen so far, comparing across different bonds, we can think about variations in the yield or the interest rates that bonds have, okay? Yield, interest rates, price, these really all mean very similar things. The price is how much a bond can sell for today. The lower the price, the higher the interest rate, which is really the same thing as saying the higher the yield. So yield and interest rate are basically the same thing in this context. So if you hear me using those terms, yield, interest rates, it's the same thing, okay? So when we think about the yield of interest rates, there's a few different factors that determine variation. One is the default risk or the rate of default, okay? So higher default risk bonds will be forced to offer higher yields, all right? So that's one factor that matters. The second status that we care about is that's relative to tax. Municipal bonds are tax-free, which means they're going to offer a lower yield, okay? So if I'm choosing between two bonds, one that's 3% and one that's 4%, okay, I might actually choose to buy the 3% bond if it's municipal over a 4% corporate bond, okay? So when we think about how bond interest rates vary across all the bonds that are offered, municipal bonds have lower payouts, lower rates. And then the third that we're going to talk about now is the term structure. And for economists, this is the one that's really the one that's discussed the most. You may have heard of discussion of something called an inverted yield curve. That's kind of what this is getting at. We're thinking about how bonds pay out relative to how long the bond lasts, okay? So the term structure is basically just thinking about the length of the bond relative to its maturity. All right, so a 30-year bond has 30 years to maturity. A 1-year bond has 1 year to maturity. And we would like to think about how interest rates would correlate or perhaps not correlate between a 1-year and a 30-year bond that's issued today. Okay, and so that's what we're going to be talking about now in regards to the term structure. And these are going to be our three conclusions. Kind of as we look ahead, some of these concepts are pretty straightforward. I'm not going to spend a lot of time on it. And some of these deserve a lot of attention. So here is kind of what we know when we think about term structures. One is that the interest rate or the yield tend to correlate. All right, when we think about bonds of different lengths, they tend to correlate. So for example, if a 5-year bond has a 6% interest rate, if we hold everything else constant, that actually will tell us something about a 30-year bond rather, okay? So in other words, if we know the interest rate on a 5-year bond, that actually is informative in determining the interest rate on a 30-year bond. Okay, so they're not going to be the same, most likely, but this isn't going to be 2%, okay, and it's also not going to be 20%. It's going to be somewhat close to that 6% rate. So what we might actually see is that this is 7%, okay? All right, so that's common. It would be very uncommon for there to be a big gap between these two. And the reason for that is pretty simple. And that is that the 30 years includes the 5 years. Okay? If you think about why you're willing to buy a bond or why you would be considering selling a bond, you're going to be forward-looking in that thought process. So for me, for example, if I'm thinking about buying a bond, what I'm really trying to do is save money, right? And if I think about things like interest rate risk, inflation risk, default risk, those things that I'm concerned about will be a concern for the 5-year period and for the 30-year period, okay? So for example, if I'm concerned that inflation is going to go up, that is a concern that's relevant to both of these. All right. If I'm concerned that interest rates are going to go up in the future, again, that is a concern that I have for both of these terms. So for that reason, if 5-year bond rates go up, that means that 1/6, right? 1/6 of the years in this 30-year period are included in this 5-year bond. So if this goes up, we also would expect this 30-year bond rate to go up, okay? So if I'm buying a bond today, regardless of the length, they all have the same first period, the first day, the first year. Those are all set the same, regardless of how many years of that bond is that you hold. So simply put, because the 30-year bond and the 5-year bond have 5 years of overlap, they have 5 years in common and thus will tend to move together, okay? So we're going to see that the length of bonds are correlated over time. So that one's relatively easy to understand, and we don't really need a whole lot of analysis to think about why that's the case, okay? But we will do a bit more analysis just to make sure we understand that the logic there. The second thing that we can see about these yields is that the yields on short-run bonds are more volatile. Okay? Now, this is a tricky one, okay? Because normally we think volatility and risk mean the same thing, but I'm not necessarily thinking about risk per se. Instead, I'm thinking about volatility, okay? So, for example, a 30-year bond might have a 10% default rate, okay? That 10% default rate is an element of risk, but that doesn't necessarily mean the bond is volatile. Okay, volatility means that the price of the bond changes dramatically over time. So if a bond has a 10% default rate risk and that's constant over time, that bond's not going to be volatile. It just has an inherent element of risk. Okay, so when we think about volatility here, let's make sure that we understand this is referring to the fact that prices can dramatically change over time for various reasons. We need to understand why this is the case. Okay, so let's think about two different bonds here. Let's think about a 1-year bond versus a 5-year bond. Okay, these are two options for bonds that I can buy, and perhaps maybe I own both of these bonds. Okay, let's say right after I buy the bond, the inflation rate goes up 1%. All right, so right after I buy the bond, the inflation rate goes up 1%, and it maintains this new level for 6 months. Okay, so we get this little burst in inflation, and then we kind of go back to normal. Think about how that would affect these bonds. All right, which of these bonds are going to be impacted more by this change? First of all, they're both going to be affected. Okay, inflation going up is meaningful. So if I buy this bond and right after I buy it, inflation goes up, that's going to make it harder for me to sell these bonds. The price of these bonds are going to go down. Okay, when the inflation rate goes up, that makes it worse to own bonds because future payments are lower. So after this inflation goes up, we would expect the price of these bonds to go down. Now, which one would be impacted more? Turns out that the 1-year bond is going to be affected more, okay? The reason being that for the 1-year bond, the increase in inflation lasts for half of the life of the bond, okay? The increase in inflation lasts for half of the bond's life. So if inflation goes up 1% and it maintains that level for 6 months, for half of the period that this bond existed, the inflation rate was higher, okay? Compare that to the 5-year bond, all right? For the 5-year bond, only 6 months of the entire 5-year period, only a 1/12 of the time was the inflation rate increased over its norm, all right? So for that reason, the inflation rate on these bonds is going to affect the one-year bond more, because the one-year bond basically has less time to wash out the effects. Okay, and you can kind of imagine, you compare this to a 100-year bond. A 100-year bond it's almost like it doesn't even factor in at all. Okay, for a 100-year bond, a little bit of extra inflation for 6 months, it's just a drop in the bucket, right? It's practically meaningless. Okay, so the longer the bond is, the more time it has to counteract any of these weird events that happen in the economy. Now, this is a bit impractical, because in reality, we don't know that this is going to last for 6 months. So instead, this is kind of more what we think about when we think about bonds. So again, we can think about a couple different bonds, maybe a 6-month bond. Right, so it's something like a CD, which is kind of like a bond, right? A 6-month CD, those are very common. And then we can compare that to a really long bond, like a 30-year bond that the federal government often issues, okay? So you can kind of imagine, just to give you another example of this, we have COVID that hits our economy, all right? So let's say right after I buy this bond, COVID enters the vocabulary of Americans, right? What that tells us is when COVID hits, the entirety of this 6-month bond, the entire 6 months will be impacted by COVID, right? Now, we don't know when COVID's going to go away. We don't know how long it's really going to affect us. But the 6 months are going to be very affected by COVID. So what that means is when COVID hits, the 6-month bond is going to see a big impact. Probably the bond is going to see a change in terms of its yield. If I wanted to sell this bond, I could sell it for a different price. Big impact. Compare that now to a 30-year bond. Now, we don't know how long COVID is going to last, but probably not for 30 years. So COVID is going to affect the entirety of this bond, the entire 6-month period, but only likely a small proportion of the 30-year bond. So even in the case where we're being more practical, even when we don't know how long an event is going to last, it's going to play a bigger role in the short run, okay? So what we would expect to see is when COVID hits, something is going to happen to the price of these bonds here. Probably the price would go up, okay? Chances are interest rates go down. When the economy is bad, generally interest rates go down. So we would expect the price here to go up probably quite a bit, all right, for that 1-year bond or 6-month bond, okay? And then for this 30-year bond, the price will probably go up by a smaller amount, all right? In other words, COVID causes prices to go up while it exists. When COVID is impacting the economy, it causes prices to go up. That will be for the entirety of the 6-month bond. But because it will only affect a portion of this 30-year bond, it'll only have a small impact on the price. Okay? So interest rates tend to correlate. You're seeing that here again, right? Prices going up, interest rates going down. They do tend to move together. But the second thing we see is that the shorter the term of the bond is, the more volatile it tends to be. The more its price tends to change. And then the third conclusion that we're going to reach, and this is the one we're going to spend a lot of time on, and this is that long-term bonds tend to offer a higher yield than short-term bonds. And this, I'm not even going to try to just answer here in just a few minutes. We're going to have to spend some more time, do some more analysis to figure out why we think this is the case. Okay, so now, to do a little bit more investigation, we're going to discuss something called the expectations hypothesis. We've seen that term expectations quite a lot in this class already, and we're going to see it some more. Obviously, expectations, just thinking about how things will change. And so the expectations hypothesis is basically just thinking if you could predict what's going to happen to interest rates in the future, that would inform your decisions today. So for example, if I knew in 2035 I could get a 1-year bond for 8%, that might actually affect the type of bond that I'd be willing to buy today, okay? So this is the expectations hypothesis. Let me give you some examples, okay? Pretty easy idea, really, I think. The The complexity comes in with understanding how bonds work, making sure we're keeping prices and interest rates straight, that sort of thing. But the expectations hypothesis, once you understand that, is not a big leap, all right? So let's think about some bonds. Let's imagine the year's 2023. You're thinking about buying some bonds and you see the following interest rates, all right? So on a one-year bond that's for sale in 2023, let's say that the interest rate on that is 4%, okay? So just to be clear here, the notation I'm using is imagine the interest rate on a one-year bond in 2023 is 4%. And let's also imagine that we could be all-knowing and we can imagine what bonds are going to look like in the future. So let's imagine that you could look into the future 1 year. So this is thinking about expectations, and imagine we had perfect expectations. We exactly know what's going to happen in the future. Then let's imagine that a one-year bond in 2024 pays 6%, okay? So we know that a bond today in 2023 pays 4%, and we know that a bond in 2024, a one-year bond in 2024, pays 6%, okay? And also, we have the option of getting a two-year bond today. So in 2023, we could buy a two-year bond for 3%. All right? So the reason this is relevant is you can kind of think of a couple of different choices. If you're hoping to invest over the next 2 years, one thing you could do is just buy a two-year bond. The other thing you could do is buy a one-year bond. When it expires, buy another one-year bond. All right? So if you want to invest for 2 years, you could go for this one, or you could buy both of these bonds at two separate time periods. Okay? So if we literally knew that these were the interest rates, what would be your strategy? If you want to invest over a 2-year period, you want to buy bonds over a 2-year period, you would certainly prefer to buy the one-year bonds, right? So you're going to buy one bond today. When it matures, you're going to buy the second bond. And in doing so, you're going to get a higher interest rate. So let's think about the effects. If this was truly occurring, and everyone really could look into the future, if we have that all-knowing ability to see what's going to happen to interest rates in the future, the effects are, one, the demand for one-year bonds would increase. All right? The demand for one-year bonds would increase. And when demand increases, we can kind of think about what that looks like for bonds. When the demand for bonds increases, what that does is it drives up the price, and in doing so, it drives down the interest rates, okay? So we would expect to see these interest rates go down because these bonds are extremely popular, all right? Right? The more that people want to buy of something, the lower, or rather, the more that people want to buy of something, the higher its price, okay? So if people are wanting to buy these one-year bonds, their price will go up and their interest rates will go down, all right? So what we would expect to see is these interest rates would drop maybe to 3% and 5% at their new rates, okay? Simultaneously, the other thing that would occur is since people are buying the one-year bonds, they're not buying the two-year bond anymore. So the demand for the two-year bond would go down. When demand goes down, price goes down, and interest rates go up, okay? And so what we would expect to see here is that the two-year bond rate would go up, and maybe it goes up to 4%, okay? Now, based on those effects, if you're wanting to invest over a 2-year period, all right, which would be better, to buy 1 2-year bond or 2 1-year bonds? Turns out it's the same, right? If these are compounding annually, it would be the same effect. All right, so you'd be completely indifferent between buying a 2-year bond or 2 1-year bonds. And it makes sense that that's what would happen, right? Because if these get out of whack, demand will shift to adjust those interest rates to a level where they approximate this effect. And that is the result of the expectation hypothesis. The outcome of the expectations hypothesis is this. If all interest rates are known, the return on a long-term bond will be the same as the average return on many short-term bonds. Okay, and to be clear here, this only works if we're thinking about the same time period. Okay, what I mean by that is if you buy a 30-year bond, and if expectations theory is truly correct, all right, in this case, if you buy a 30-year bond, that would yield the same return as the average of 31-year bonds, okay? This is basically just recognizing that there's no such thing as a free lunch, okay? It's not disproportionately profitable to buy long or short-term bonds over time, all right? They're equally valuable over time. So what this would suggest is we can make some predictions about the way bond interest rates work. So for example, if we're talking about a one-year bond in 2023, a one-year bond in 2024, and a one-year bond in 2025, and maybe they look like this. Okay, so interest rates are dropping over time. That's totally reasonable, okay? In expectations hypothesis, interest rates can absolutely change over time. It's just that the long-term bond will incorporate the fact that interest rates are changing, okay? So given this information here, what that would tell us is the interest rate of a two-year bond in 2023 would be the average of the two individual one-year bonds coming up, okay? So we would expect to see a 6% return for a two-year bond in 2023. The interest rate on a three-year bond in 2023 would be an average of these 3 years, giving us a return there of 5%. So basically, again, what this shows us is, if this is true, we know this isn't true, by the way, but this is kind of like a starting point for us to think about how this works. So if this was literally true, you would be equally well off just buying a bunch of one-year bonds and just, rebuying. That would yield the same return as buying a longer-term bond over that same time period, okay? However, here is the problem. We know that long-term bonds usually, and by usually I mean more than 90% of the time, I don't know the exact figure here, probably something like 95 to 98% of the time, long-term bonds offer higher yields, higher interest rates than short-term bonds. Okay, so what this suggests is that for some reason, if we think about the demand for bonds, this is probably what's driving it. For whatever reason, investors would just prefer to buy short-term bonds relative to long-term bonds, okay? So if we use that same analogy here, thinking about one-year bonds into the future, so maybe it looks like this. So this is a scenario where interest rates are anticipated to stay the same for one-year bonds, okay? If the expectations theory argument was literally true, then the interest rate on a three-year bond in 2023 would just be 4%, right? Okay, right? Because if you could buy individual bonds that earn 4% each year, well, then a 3-year bond will also pay 4%. In other words, you're equally well off buying either if you're an investor. But what we actually see is that the return on the 3-year bond will be higher, maybe something like 5%. And a ton of research, a tremendous amount of time and effort has been spent in trying to figure out why this is the case. If you end up studying finance, like in a master's degree or the PhD level, you're going to spend a lot of time thinking about why this is the case. The timing element of interest rates is really important to investors. When you're thinking about whether it's a good time to issue bonds or to buy bonds, the term length, the interest rates you get on different term lengths is going to be relevant. Extrapolate from that. If you're thinking about buying stocks, well, a substitute for stocks is bonds. So to understand whether it's a good deal to buy stocks right now, you need to think about what interest rates are like. When you think about exchange rates, if you think about putting your money into a different currency, well, one other thing you can do rather than exchanging your money is invest it. So bonds again become relevant. So this decision in terms of why this offers a higher rate is really important, and we're going to dive into this now. Okay, so we have this little puzzle, and that puzzle is that interest rates on long-term bonds are usually higher than short-term bonds, and it's not really borne out by just thinking about the expectations theory, so there must be some other answer. And we think we kind of have a good feel for what that answer is at this point. Like I said, there's a lot of research that's been done on this, and there's no way to really prove what's causing it, but we do have some ideas, and some of these are, I think, kind of obvious, okay? In general, this preference has a name. This is called the liquidity premium, which is just the general preference for shorter term bonds. Okay, that's a liquidity premium. So we need to think about why people would prefer shorter bonds, ceteris paribus. Okay, so for you, if you were thinking about buying a bond and you're given the choice between a 3% interest bond for 1 year or a 5% interest bond for 10 years, thinking about making that choice, it turns out a lot of people would actually choose the 1-year bond even though the interest rate is lower, okay? And so we have some reasons why we believe this is the case, and most of it boils down to risk. And when it comes down to risk for bonds, there are 3 types of primary risk, okay? These are not the only elements of risk that exist for bonds, but these are the 3 primary issues for bonds. One is default risk. And this is just the risk that the person or the bond issuer never pays you back, okay? To default means to not make your payments. So the default risk is just the risk that they never make the payment, okay? And the thing about default risk is it should be higher in the long run. Hard to prove this, okay? It's hard to prove this because the thing is we have only historical data to work towards, to look back to. There's no way to look into the future and make sure that this is always validated. So for example, at some point in the future we could have a catastrophic event like a meteor hitting the earth. If a meteor hits the earth, that's going to affect way more long-term bonds than short-term bonds. So, for example, if I own a 1-year bond, there's only the chance that the meteor hits the earth in that 1 year. But if you own a 30-year bonds, that creates 30 times more years, 30 times more chances for something catastrophic like a meteor hitting the earth, okay? That's just one example, but that is plausible, right? It's plausible that there's some event like a meteor hitting the earth or, a really bad war. And those types of things could create tons of defaults, right? If we have wars, you can imagine tons of companies shutting down, the government not being able to repay its debts. All those things could happen, so you get tons of bond defaults. So it should be the case that default risk is higher in the long run, but there's really no way to prove that that's the case. Historically, there's not really a clear connection there. When when we think about bond risk, another type of bond risk is inflation, okay? When inflation goes up, that is good for the borrower, right? So it's good for the borrower, good for the person that sold the bond, but that is bad for the buyer. All right, the lender, the person that is buying the bond, it's bad for them, okay? We do not know what's going to happen to inflation rates in the future. Inflation is kind of one of those things that's hard to predict, in particular in the long run, okay? So we can't really predict this, but the bottom line is we know that people are risk averse. So the fact that inflation could go up or could go down means that inflation risk is relevant, all right? If we knew that inflation was going to stay the same over time, then it doesn't really matter, all right? Inflation becomes irrelevant. If we could predict what inflation would be in the future, even if it went up or down, we could price that into the current price of bonds, okay? We could basically take future information and use that to determine what the prices should be today. However, we can't do these things, okay? Since we don't know what's going to happen to inflation over time, and because people are risk averse, that makes you less likely to buy a bond. The simple fact that I don't know what inflation is going to do in the future makes it less likely that I'm going to buy a bond or issue a bond, okay? So here is the bottom line, okay? Longer term bonds are exposed to more risk, all right? Now to be clear, all right, I said before that short-term bonds are more volatile. This can be a very confusing thing. Short-term bonds are more volatile. In other words, if inflation goes up 1% today, that will affect one-year bonds way more than it'll affect 30-year bonds, okay? However, 30-year bonds have more periods in them. So although a change today has little bearing on a 30-year bond, so a little bit of inflation today doesn't have a big effect on bond prices for a 30-year bond, in the case of a 30-year bond, you've got 30 years of potential inflation, all right? So if we can kind of imagine that over a 30-year period, you know, at some point inflation will probably be above 10%, probably will, right? At some point inflation will probably be negative, okay? That represents some significant potential swings. So for that reason, the inflation risk is more pronounced over longer periods of time, okay? The same can be said for interest risk. All right, in the case of interest rate risk, just to make sure we understand what this looks like, imagine bonds have just been issued. So there's a bunch of bonds that have just entered the market. And then right after that, interest rates go up, okay? This is really bad for the lender. Bad for the lender, bad for the buyer of bonds, because they could have waited to buy new bonds. So if you buy a bond at 3%, and then right after that, bonds go up to 4%, you missed out on an opportunity, okay? So that would be bad for the lender. And if you go back and you try to sell your pre-existing bond now, it's going to get a much lower price, right? The discount effect there will have changed. On the other hand, this is good for the borrower in a way. All right, now this doesn't change the interest rate that the borrower is going to face, okay? But what this means is they borrowed at a relatively good time. So if I get a mortgage and I get a 2.5% interest rate, and then the next day interest rates go up to 3%, I got a good deal. So I'm going to be happy with that outcome, okay? Just like in the case of inflation, the problem with interest rates is that we can't predict them very well. We don't know what interest rates are going to look like next year or 10 years down the road. So since people are risk averse, basically they're going to focus more on the potential bad. That's kind of what risk aversion is about. When we think about what could happen, you know, interest rates could go up, they could go down. It's kind of, in terms of our expected value, it's sort of irrelevant, right? Interest rates could go up, that could be bad for the lender, but they could also go down, which would be good for the lender. All right, but here's the thing. Risk aversion means that people are going to be more concerned about the bad. So if they're worried that interest rates could go up, they might just not buy bonds at all. All right? So this is actually just like we saw for inflation. Longer term bonds are more effective. Longer term bonds are exposed to more risk. Again, keeping in mind that risk and volatility are not always concepts that move hand in hand. If interest rates suddenly go up right now, so imagine a whole bunch of bonds have been issued, 1-year bonds, 30-year bonds, and so forth. Right after that happens, if interest rates go up, okay, that will affect short and long-term bonds. But if interest rates go up today, that will have a much bigger impact on the 1-year bond. Because if interest rates go up today, that 1-year bond is probably going to be, its entire life will be affected by that 1% change. On the contrary, for the 30-year bond, a 1% increase today matters, but there's probably going to be a whole bunch of years that really have basically canceled out that effect, right? If interest rates go up today, that's not going to last for 30 years. It's only going to last for maybe a year or two. So for a 30-year bond, the effect would be much smaller. So prices for short-term bonds tend to move more in the short run, but longer-term bonds have more risk because they've got more time for something crazy to happen, right? Over 30 years, there's a greater chance that interest rates go way up or way down. So there's more risk for longer-term bonds. So basically, what we can suggest from that information then is that the liquidity premium is really just a risk premium. Okay? It's just a risk premium of sorts. Because people are risk averse, and because longer term bonds have more years to be exposed to these potential changes, we can make the argument that this is just a risk premium. This can't be proved, however, okay? You can make some pretty compelling counter arguments to this, okay? So for example, over a 30-year bond, you could make the case that over a 30-year bond, interest rate risk is bigger because they're exposed to more risk. That's true. But on the other hand, for a 30-year bond, you might think that the risk cancels itself out. Over 30 years, interest rates may go up for a while, then they may go down for a while, and maybe it kind of just washes out over the long run, right? Basically, over the long run, the highs and the lows cancel each other out, okay? But here's the thing. We know that longer-term bonds offer higher rates almost all the time, which indicates that there is something like a risk premium that is happening, okay? So from that, we can now introduce a concept, a nice, simple little graph called a yield curve. Last time I taught this class, we had an inverted yield curve, and everybody gets all up in arms about inverted yield curves, okay? So we need to understand how this works. A yield curve, very simple graph. It's just a graph showing the connection or correlation between the yield, all right? Keep in mind, yield just means interest rate, okay? It's just another term for it. So it's a graph showing the connection between the yield and the time to maturity. Okay? So it might look something like this. That's the time to maturity. That's the years, okay? So usually we see this in terms of years, but it could be days or whatever as well, right? So that's the time to maturity. Here is the yield. That's just interest rate, okay? And then we could see what the yield curve actually looks like, okay? So we might see that it looks something like that, which would kind of be pretty common, upward sloping. And we've got to be clear, okay? What this is showing us is not what's going to happen to bonds in the future. Students make this mistake all the time, okay? They look at this and they think this is telling us what bond rates will be in the future. That is not the case, okay? If the current year is 2021, okay, then what this would tell us is what we would expect to see at different lengths of bonds issued now. So maybe a 1-year bond in 2021 offers a 3% return. And maybe that's what we're seeing right here. Okay, so 1 year into the future, or a bond that will mature 1 year from today, a bond issued today, but will mature 1 year from today, pays a 3% return. Whereas a 30-year bond that is issued today might pay a 5% return. And so that would be kind of like a data point way out here. Okay? So it doesn't tell us anything about the price of bonds or the interest rates of bonds in the future. It's telling you the price of currently issued bonds that all have different times to maturity, okay? So here is what we know about this curve in regards to the interest rate premium, the risk premium that we were referring to a bit ago. So let's start with expectations theory and then move our way into thinking more realistically about the way bonds work. As an example, imagine that 1-year bonds are expected to return 4% forever. Okay? 1-year bonds are expected to return 4% forever. And this is kind of weird because we now are actually thinking about bonds in the future. And the reason we're doing that is, remember that the expectations theory suggests that long-term bonds are just average returns of individual shorter-term bonds, okay? So what this would tell you is a 1-year bond in 2021 would pay, 4%. And then a 10-year bond in 2021 would also pay 4%. And that's based on the logic that, 8 years, 9 years into the future, I can continue to buy 1-year bonds for 4%. So all bonds are basically going to end up being 4% if we ignore like default risk and that sort of thing, okay? Now let's consider risk in this, okay? So if we draw our little yield curve here, time to maturity, the yield up here on the y-axis, okay? This is that 4% return that would be anticipated by the expectations theory. If everyone expects bonds to return 4% in the future, then we would expect that the length of all bonds would be 4%. Okay, so 30-year bonds would be 4%, 10-year bonds would be 4%, and so forth. That's what expectations theory would suggest. After all, right, if a 30-year bond returned 6% and 1-year bonds always returned 4%, well, then everybody would just buy the 30-year bond, right? And that would drive down its interest rate over time, okay? However, what we know is the expectation theory is not fully correct because it does not incorporate the risk premium. So if this is the expectation, in reality, the yield would look something like that. So the yield curve is increasing at some rate relative to what the expectation theory would suggest, all right? The difference between these two here is that risk premium that we're talking about. So not only is there a risk premium, but what we believe is that the risk premium is higher over more years. So a 6-month bond has a teeny risk premium, a 10-year bond has a bigger risk premium, and then, a 30-year bond would have an even larger risk premium, okay? So what we have is evidence that the risk premium grows as the time to maturity increases. So that suggests that longer term bonds have more risk, okay? If it's indeed risk that's driving this effect, then that's what we believe is causing that difference, all right? And this is consistent. If longer term bonds have more interest rate risk, more default risk, more inflation risk, then a 30-year bond should have a bigger risk premium than a 10-year bond, right? Because a 30-year bond has 3 times more years to see some sort of catastrophic effect in the future. So that's the basics of the yield curve, and now we can start thinking about why an inverted yield curve would exist.